Hello guys, in this video I'll discuss a very good option selling strategy which is suitable for the present market scenario where we are not getting much move and the premium is less and the VIX is around 12, 13. Okay, see, in fact, one of the biggest concern for option sellers is the large M2M swings, right? Ultimately, we know it may come within our range also, but still this M2M swing is sometimes may not be manageable or uncomfortable, and many traders have profitable strategies, but you're unable to hold those trade despite knowing that this is going to be the range. Maybe because your M2M fluctuation becomes so much uncomfortable for you, and the sudden volatility that is actually creating some kind of emotional pressure. We all are human being, and when you're dealing with money, and that's natural. And the positions, I have seen many of you might be exiting prematurely also, despite knowing that this is going to come down and this is going to become close to zero, but still you will not be able to hold that and you exit prematurely and you just keep watching that the premium is kept on melting and coming within your range. So because of that, an ideal strategy, in fact, should not only generate profit, but in my opinion, at least if you are a risky, such a kind of risk taker like me, then it's okay. But otherwise, if you're very conservative, keep your M2M fluctuations relatively controlled. So that will give you peace of mind also, and that keep you comfortable also, and that won't give you any, unnecessary emotional pressure also, and you won't exit the trade prematurely. And that one strategy that I'll be discussing here is double calendar ratio spread. So this is more suitable in the present market scenario where the low VIX environment, you find the premium is also lower. So see, before we have seen large expansions and the premium VIX is also rising. We have seen 20, 25 levels during the wartime, but that's not the scenario now. So this scenario, this is one of the best strategy, and this strategy is actually designed for low VIX condition. For example, now the VIX is around 12, 13. So it is good. And that kind of environment, the premiums are relatively low. Now, the logic of low premium is, let's say if the straddle on the expiry day, now if you see last week Nifty expiry day, the straddle is priced at 120. Market opened on Tuesday, straddle is priced at 120, which means what you're expecting is 120 point on the upside, 120 point on the downside is the range that you're actually looking for. But 3 weeks back, you were getting around 200 plus, in straddle premium, which means you are looking for 200 point up move, 200 point down move, and you are getting a battlefield of 400. But that's not the scenario now. Now, the premium move is also very less. The range is also very less. VIX is also very less. Premium is also very less. Volatility expansion is very less likely, right? Sometimes when the VIX low scenario is there, sometimes unexpected spike also comes that you need to manage. But 99% of the cases, the volatility expansion is very much unlikely. So in this scenario is where the calendar spread become more attractive. See, in fact, the strategy can be applied to Nifty, Sensex, and other any optionable instrument you have. You can use this. In fact, its primary advantage, appears during stable volatilities or stable market condition, like the present situation that you are in. This is something which is a better strategy. Okay, so let's talk about this now. The objective here is not maximum profit. The objective here is a stable M2M. That means I don't want to be emotionally disturbed. I don't want to be uncomfortable by seeing the M2M swing. If I'm comfortable, see, for me, you give me any strategy, I take strategy, right? I start with, if I have some directional view, I start with direction. And if my view went wrong, I convert that to straddle. And then again, I make it into directional. I change the ratio like that. I'll always try to maintain the straddle only because I am a risk taker. My style is entirely different. But if someone don't want to see such kind of M2M fluctuation, and I'm always there in the market also, even if I'm having a straddle, let's say 40, 50, 60 delta, if I'm having straddles at the money and one out of the money, one in the money, I keep doing that and I keep shifting that. I'm always there in the market. So for me, straddle is what is always better. And never I go directly with the straddle. If I'm having no clue, then start with a non-directional straddle, right? Otherwise, I start directional, and then if I go wrong, I convert that to a straddle. If I go correct, after some point, I start the opposite position also, because market tend to be in the range. That's what I do. But here, let's talk about this calendar spread that I'm going to talk about. The first principle here is, this is what I need to tell you. If my objective is to maximize profit, then it is straddle only, not even strangle, not even any other strategy. It's only straddle. That's where I get the maximum premium, both at the money, I get the maximum premium. or directional. If not straddle, directional. That's why I told you I try to maximize profit. So I start directional, I convert to straddle, or I start as a straddle and then I convert to directional. I start as a non-directional straddle, and then when it comes to a certain level, I sell extra there. Let's say I started at 24,000. If it is going to 24,200, 24,000 I sell a straddle as a non-directional view, and then I see a movement till this level, then I sell extra call. So the ratio will be now 2:1. Then it becomes directional. Then I try to make it in this range. If it is breaking, then accordingly I will adjust. So I try to squeeze maximum profit, and mostly there will be straddle or directional. So the best way to get profit is maximum profit is directional, otherwise straddle or the combination. But here my objective is to not to make maximum profit. My objective is to make or see the stable M2M, right? So here, when your M2M is under control, you can hold position, right? Psychologically, that is more easier, and your decision making also will improve, and your emotional trading also will reduce. So let's discuss a strategy. The first step is, as of now, when I'm recording this video, Nifty is at around 24,000. So current level of Nifty is 24,000. Now, estimate the probable week range. So weekly range, I can take, let's say, 500 point upside and 500 point downside. So 24,000 where Nifty stands at. So 24,500 on the upside, 23,500 on the downside. So I'm defining my range, okay, right? 24,500, 23,500. As Nifty standing at 24,000, I'm looking for 500 point upside, 500 point downside. So 1,000 point is my battlefield. So 1,000 point is the trading zone here. Now, historically, if you see, markets spend a significant portion of their time trading when, within approximately 2 to 2.5% weekly range. 2 to 2.5%. So 1,000 point when I'm taking, when Nifty is at 24,000, it is very clear within the range, right? So the objective is basically to construct a strategy that performs well if the market remain inside this expected range, right? So historically, the probability, higher probability is that market will stay in a 2 to 2.5% weekly range unless something big is happening positively nor negatively. So what is our objective? Our objective is that we are going to construct a strategy that performs well if the market stays inside this expected range, because historically this is what market have moved. So this is what is expected range. Okay, so that's the objective. Now come to the step 2. You need to build that initial short position. So you move 2 delta. Let's say on both sides, we take 2 delta options. So sell 3 OTM calls and 3 OTM puts also. 3 OTM calls, 3 OTM puts, and you can go with 2 delta on both the sides. Okay, so 2 delta options starting with 3 calls and 3 puts OTM, and that create your first structure. Now, so this is the first structure, right? Now, at this stage, if you look at this strategy, this resembles a naked ratio-based premium selling structure. But remember, this alone carries significant M2M risk. Now, why simple selling is not enough is because a naked short option structure may in fact produce large M2M fluctuations. So here it is naked, and there can again be significant emotional stress also and difficult position management. So what we need is, we need protection in terms of margin also, in terms of avoiding that M2M fluctuation also, we need the protection. So what we are going to do is, we are going to replace the traditional hedge. See, what is a traditional hedge approach? You will buy far OTM option in the same expiry, right? So that effectively create a structure which is similar to iron condor, right? So iron condor means what? You sell out of the money call, you sell out of the money put. So you created a strangle, and then go beyond this, and you will be buying protection for the call, and you'll be buying protection for the put. So this is typical iron condor. So instead of using distant hedge, so the strategy that I'm going to discuss, that actually introduce calendar spread hedges. That means you are going to use the next week expiry. Okay, so first you created a position, and then instead of making this week expiry for hedging, which eventually convert that position into iron condor, what we are going to do is, we are going to use calendar spread hedges, which means next week expiry is what we are going to use, right? So current week, what you did, you sold 3 calls, you sold 3 puts out of the money. Now next week is where you are buying for protection. So you'll be buying 1 call, which is approximately 30-35 delta, and then you buy 2 calls, which is near 20-25 delta. So you already have 3 call sell. Now we need 3 protection. So 1 call will be around 30-35 delta, 2 calls will be around 20-25 delta, And exactly the same you will do on the put side also, which means you will also have to buy 30-35 delta put hedge for the next week, and 30-35 delta 1 and 2 put hedge you can do at 20-25 delta. Cool. So this is what you need to do. That means your total hedge quantity become like 3 long option is there, 3 short option is there, right? So if you look at your position now, you have 3 call sells in the current week and 3 call buys in the next week, and this next week is your hedge. Similarly, 3 put sells in the current week and 3 put buys in the next week, and that we spread in 2 different deltas also, and the buy and sell options also we spread into 2 different weeks also. Now, what is the final position? Let me be very clear here. Current week, we have 3 calls sold, 3 puts sold. This is naked. So what we need? Protection. Now, if I take protection here this week, then it becomes iron condor. What we are doing is calendar spread protection, calendar spread hedge, right? So what we do next week, we need to hedge, right? So we have 3 call sell position. So we need 3 call buys, and 1 call buy I will do nearer the strike, right? Around 30-35 delta, and 2 calls I will buy around 20-25 delta. Similarly, we need to buy 3 puts also. In that, 1 put I'll buy around 30-35, and 2 puts I'll buy around 20-25 delta. So this is actually creating a double calendar ratio spread. Now, how the structure is going to work? See, the nearby long option, the one which you have, that act as an immediate hedge against the directional movement. Any directional movement, this will act as a very immediate hedge. And the additional 2 long calendar positions that you have, that provide protection from adverse movement over a period of time. So together, this 3, in fact, give you a smooth payoff curve. If you look at the payoff curve, I can show you, but then that is going to take a lot of time. So if you can also create the structure and you can look at the payoff curve. So you will see a smooth payoff curve, and M2M swing also will reduce, and that will improve your holding capacity and holding power. So see, compared with simple option selling, in fact, the payoff, if you see here, that becomes more smoother, more wider, and more kind of forgiving. So instead of sharp M2M fluctuations, you'll be much better here. This strategy, in fact, develops a flatter risk profile. So the main objective, I told you, it is not to maximize the profit, right? The purpose is not to make maximum profit, peak profit. The purpose is to reduce drawdowns. So if the objective is to make profit, then I'll go directional, right? Or if I'm not having any clue on directional, if I can take risk without being directional, I can go with straddle if I know the adjustments. That is when you have your objective as maximizing profit. Not even strangle. Strangle risk reward, if you take straddle, is always better, right? So I can the same example which I have given, you can use, right? So you can talk about Nifty at 24,000. So you go and sell 24,000, let's say 300 call and 23,700 put, right? That options you can sell, and then what you will do next week, you will create the long position. 1 can be nearer the strike, and 2 slightly farther the strike. So here you will create for both calls and puts, you need the hedge, right? And margin requirement for this is approximately around 3 lakhs is what is actually the margin required. And what is the expected return? Expected return will be around 1%. That will be the return on the deployed capital that you can expect. And see, the strategy can be adjusted again depending upon the VIX. If VIX is around 13, you'll maintain that center profit. The reason is VIX volatility expansion risk is relatively limited. If VIX is around 10, then shift the nearer hedge slightly closer. So as a result of it, what will happen is the center profit will reduce and the payoff becomes flatter and M2M becomes even more stable. And this adjustment, in fact, sacrifice profit, in exchange for a greater protection. You'll be getting more protection. So guys, see, higher the safety generally means what? Lower the maximum profit. Now, if you want maximum profit means what? Slightly more risk is there. So here safety is more, that is why profit is actually less, right? So lower safety, if you have, then I can go with a potential higher returns like the strategies, right? So here the objective I told you in the beginning itself, it is basically to control the risk and be comfortable, and consistently you will make that 1% like that only. Now, if you compare it with iron condor, what is the difference? It is very simple. In case of iron condor, the hedges will be in the same expiry and M2M swings can be even larger. payoff width is also comparatively limited. But here what we are doing is double calendar ratio spread. So we are using next week expiry for hedges, and current week is what we solve. So you have a better M2M stability and wider effective protection zones also what you're getting, right? Now, why the calendar heads actually help here? See here, longer dated option in fact retain more time value. So in the sold option will melt fast. The time value will be holding in the longer option. More time value is there, and better responsiveness to volatility is also there. So that is basically improving your overall position stability as well, right? So the same example, you can just try again one in Nifty. The only difference is when you're selecting the strike price, right? The overall idea, the logic should remain identical and it should be the same. So current expiry, you will sell 3 calls, you'll sell 3 puts, and next expiry, you will buy, 3 puts and 3 calls, out of which 2 lower delta option, 1 slightly higher delta option, the one which is closed, right? And repeat this on both call and put side. So this is what you need to do. And the strategy performs well, under 3 broad situations. What are the 3 broad scenarios? First, time decay benefits the position, sideways market. So if the market goes sideways, then time decay will be in your favor. And if you're getting a gradual directional movement, then the calendar hedges provide the protection. And if you're getting mild trend followed by any kind of consolidation, and still the strategy can remain profitable. So see, avoid trying to maximize the returns. In that case, risk is also higher. If you are a trader like me and my approach, then that's, I start with directional, I go with non-directional, or I start with non-directional, I go with directional. So in a day, I keep shifting directional, non-directional, directional, non-directional. I start as directional. If it proved wrong, then I shift to non-directional. If I start non-directional, then I cast the direction, then I shift to directional. So I keep changing the ratio. Within the straddle itself, I just maintain the straddle and I just keep changing the ratio. So here, if you want peaceful, if you want comfort, then target approximately 1% weekly return, right? So if you have, let's say, 3 lakh capital, you have to look at, 3,000 to 4,000. That may be sufficient. And once you achieve this, you can exit the trade and, you can be peaceful. So the objective is small, repeatable gains rather than, trying to extract every possible rupee from the position, right? Why? Because the greed, in fact, often convert the profitable position to losing trades. Therefore, consistent exit, that becomes more valuable than, you're trying to maximize the profit. So these are the things that I want to discuss, and the same concept you can apply in monthly expiries also, right? So if you're using this in monthly expiry, you'll get wider trading range, larger protection zones, larger battlefield, and greater flexibility also. So since monthly, 2 delta options are much farther away, the overall structure naturally becomes broader. So you get a wider range. So what are the advantage of this strategy? Simple, lower M2M fluctuation. That's what I want. Better, psychological comfort is what it is giving, and calendar spread advantage you are getting. Suitable for the low VIX, the present scenario, and wider effective payoff you are getting, and better adaptability than any traditional iron condor. But the limitation is, this strategy is basically designed primarily for this low VIX environment. It may require adjustments when volatility expands sharply. If tomorrow Trump coming and saying something, or the war starting and volatility shoot to 16 and 20, then we need an immediate adjustment. So if the market is entering into extremely directional phase beyond that range which I have told you, then also we will be in trouble and we need to adjust accordingly, right? So always remember, the objective is not to maximize profit or maximum payoff. The objective is stable M2M, controlled drawdowns, and consistent weekly returns. So this is what I want to do. So I can repeat this once again. First step is identify that expected weekly range, and then sell 3 lower delta calls and out of the money from current expiry this week. Call and put 3 you will sell, and we hedge it with calendar spread. Next week, next expiry. So 3 calls and 3 puts sold. So we need hedge for those 3 and 3. But 1 we will take nearer delta option, and 2 slightly farther delta option. And do the same on both calls and put, and allow theta to work in favor of you. You can target approximately 1% weekly returns. Once you get that, you get out of it, right? And maintain that disciplined exit rather than trying to chase maximum profit. So guys, the double delta, this double calendar ratio spread is a low volatility premium selling strategy. When the VIX is like 12, 13, that is the market for which it is actually designed, and it is designed to achieve that consistent weekly income by minimizing the M2M fluctuation. If you're someone who's above 50 and who's very much concerned about your M2M fluctuations and if it affect your emotions and all, then this is something which you can try. So its strength, if you see, that lies in predicting market direction, but not in combining, in fact, not in predicting market. We don't want to predict market, but we will try to get advantages of all this. Theta decay will try to get calendar spread advantage will get, and the ratio based hedging will be getting, and we also need to do the discipline management. And when you appropriately execute this in low VIX condition with realistic profit expectation, then the strategy gives you smoother and psychologically easier trading experience than conventional premium selling structures. Like, you don't want to go with iron condor or straddle, where you struggle with that M2M fluctuation, even strangle also. This is something which is smoother, wider, and you'll feel comfortable. Just try and see what is actually happening, right? It's very simple. Just try it out. See